Hello, and welcome to this webinar on the IASB's recent exposure draft, Disclosure Requirements in IFRS Standards, a Pilot Approach. I'm Catherine Donkersley, and I'm joined today by IASB board members Tadeu Cendon and Tom Scott. This is our second webinar discussing the proposals in the exposure draft. The introductory webinar that we did last month provided an overview of all aspects of the proposals. In this second webinar, we will delve into more detail on the board's proposed new approach to developing disclosure requirements. We'll look in particular at some of the most common questions and hot discussion topics that we've been hearing about the new approach. Those hot topics relate to the application of judgment, audit and enforcement, comparability of information, and finally, electronic reporting. I'll be highlighting the kinds of questions we've heard and asking Tadeu and Tom to share their views. We have received a few questions in advance of the session as people were signing up. Thank you for sending those, and we will be answering them. And if anyone in the audience has additional questions for us today, then please use the box on the left-hand side of your screen to submit them, and they'll come through to us here. We'll save plenty of time at the end to respond to your questions. Just to note also that if you'd like to download the slides that we're using today, you should see a link to do that on the left-hand side of your screen. You can find information about the exposure draft, including that introductory webinar that we did last month on the IFRS Foundation website. There's a link here on this slide. One final note before we get started is that, as always, the views expressed during this webinar are those of myself and the other presenters. They are not necessarily the views of the IASB or the IFRS Foundation. So we'll start with a brief recap of the board's proposed new approach. I'll stick to the key points here as we covered this in some detail last time. It may be worth having a listen of that introductory webinar if you'd like more detail on any of the points that I talk about on this slide. So what the slide does is summarise three key aspects of the proposals. Each of these is a direct response to all of the things that companies and other stakeholders have told us would help them to improve disclosures in their financial statements. So first, we've had a lot of feedback that companies and indeed other stakeholders such as auditors and regulators need a detailed understanding of why information is useful to investors. That's to enable them to apply effective judgment about whether information is material in their particular case. So with that in mind, the first key proposal in the board's new approach involves detailed engagement with stakeholders, including investors, early in the process of setting disclosure requirements. The board would explore not just what information investors want, but also why they want it and what they are likely to do with it in practical terms. The board would then use all of that input to develop disclosure objectives that explain those investor needs in detail right there within the standards. Now, the second 2 points on the slide are very related, so I'm going to talk about them together. A very common piece of feedback is that stakeholders often perceive the easiest way to achieve compliance with disclosure requirements is to apply them like a checklist rather than by using judgment. On a related note, stakeholders consider there to be a high volume of prescriptive requirements to disclose particular items of information. They say complying with those prescriptive requirements doesn't really leave time for applying judgment about whether the items are actually material. Again, we've heard that this contributes to that checklist mentality. So what we hear is that, practically speaking, some see disclosures in financial statements as more of a compliance exercise than as an effective tool for communicating with investors. And the board's proposed new approach addresses that feedback in a couple of ways. First, by requiring companies to comply with those detailed disclosure objectives that I mentioned. To comply with an objective, as opposed to a requirement to disclose a particular item of information, a company will have to apply judgment. That's because disclosing the information that is most relevant to investors is the way to meet those objectives. Put another way, applying this approach, effective communication with investors would become the best way to achieve compliance with disclosure requirements. Second, the board proposes to minimise prescriptive requirements to disclose particular items of information. Instead, the standards would include items of information that may enable a company to meet the objective, but in most cases, disclosure of those items would not in itself be mandatory. Now, one question we always get here is, does non-mandatory mean that I can disclose nothing? And the answer is absolutely not. Whilst particular items of information would generally not be mandatory requirements, companies are required to comply with those disclosure objectives. So if something is material, then it will need to be disclosed. In practical terms, the proposed approach would enforce judgment and take away that perceived checklist. And it's that need for judgment being so fundamental to the proposals that forms our first discussion topic today. As we covered in the introductory webinar, ineffective application of judgment around materiality is a big part of the disclosure problem that this project is aiming to help to address. One question we hear then is that if application of judgment today is part of the problem, why is the board now proposing an approach for which compliance entirely relies on effective judgment? So, Tom, could I ask you please to talk a bit about why, as a board member, you are comfortable with this?
Absolutely. Thanks, Catherine, and hello, everyone. It's a great question, and I have several things to say. First, and importantly, is the fact that IFRS standards already require judgment. This is generally true, given that standards are fundamentally principles-based, and this certainly applies to disclosure. It is true that today's disclosure requirements are largely made up of prescriptive requirements to disclose particular items of information. On the face of it, one could argue that no judgment is needed. The preparer can simply work down the list of requirements and disclose each and every one. However, that misses an important element of the standards that is captured in IAS 1. That standard contains a requirement that essentially says if something is material, then it needs to be disclosed, irrespective of whether the item appears as a prescriptive disclosure requirement. On the flip side, IAS 1 says that if information is not material, then it does not need to be disclosed. And again, that is irrespective of whether it is captured by one of those prescriptive requirements. To my mind, these proposals are not introducing a big new concept. Having to apply judgment to disclosures, that requirement already exists. However, it is fair to say that the required judgment is not always being applied across disclosure requirements today. So it is fair to question how we could move to an approach that relies more heavily on judgment. There are a number of things that make me comfortable with proposing the approach in the exposure draft. The first is the change from a compliance focus that you already mentioned, Catherine. That is, moving the focus of compliance requirements from items of information to disclosure objectives. In a practical sense, what this does is reinforce the overarching IAS 1 requirements to apply materiality within the disclosure section of individual standards. It is essentially the same requirement, but it would be more prominent under this approach. What we are proposing here is to put that requirement to apply materiality right there in individual standards by requiring companies to meet the disclosure objectives. At the same time, removing the focus from the lists of prescriptive requirements clearly makes the application of judgment the first and most important consideration when it comes to disclosure. In fact, the proposed approach requires this to be the case. The second thing to say is that the proposals we develop applying this approach would give companies more tools to help them apply effective judgment than just having the overarching requirement in IAS 1. One example is the detailed disclosure objectives and the information about investor needs that will be located right in the standards, helping companies to make those all-important materiality judgments. And the final thing I would say, and this is really important, is that we are not just proposing changes to the words in the standards. As a board, we have also interrogated our own process and asked ourselves some questions about what we can do better to help stakeholders apply more effective judgment. Accordingly, the proposed approach includes a number of process steps for the board to apply that we believe will make sure we develop disclosure requirements that will give companies the necessary guidance to apply that all-important judgment.
Thanks, Tom. And for the benefit of the audience, those process steps you're talking about are laid out in some detail in the basis for conclusions to the exposure draft. So one example that we've already mentioned is those all-important interactions with investors. That's the kind of process matter that's giving you confidence in the proposals, right?
Yes, exactly. On that point, we have set a bar for ourselves that we need to reach through our investor outreach. That is the ability to write down simply and clearly what investors want and exactly why they want it. If we can't do that, then we need to do some more work. Once we have that understanding, we will reflect it in the proposals so that companies and other stakeholders can also benefit. Another key piece of outreach that would form part of our process is talking to preparers and investors together. This proved highly beneficial when we tested the process on IFRS 13 and IAS 19. In these conversations, preparers were able to understand user needs and debate different pieces of information that might satisfy them, identifying information that may be easier or less costly to prepare. These discussions enhance our ability to reflect user needs in the most clear and helpful way possible in the proposals, and to make sure we capture preparers' input about effective ways to satisfy them. I will give one other example of our proposed process that I think is valuable, and that is interrogating common practice. We have a great IFRS taxonomy team that research disclosures in common practice. Amongst many other things, this process identifies information that companies typically choose to disclose, including when it is not explicitly required today. Almost by definition, such information is being disclosed because it is useful to investors, and therefore it is likely relevant in satisfying their needs. This common practice information is something that we can learn from in terms of standard setting, particularly when it comes to identifying items of information that may enable a company to meet disclosure objectives. By reviewing common practice, we are confident that we will identify in the standards information that is likely to be relevant and material to multiple companies in satisfying disclosure objectives. Identifying these things in the standards and explicitly linking them to disclosure objectives will help companies to identify potentially useful information and judge whether it is relevant in their case. So overall, it is absolutely not the case that the proposals require stakeholders to apply judgment to their disclosures for the first time. Instead, what the proposals do is to provide preparers with more to work with when applying the judgment that is already required. That is the main reason I am comfortable with exposing and testing this approach that relies on the application of judgment.
Thanks, Tom. So you just mentioned at the end there that you are comfortable with testing the approach. It seems that that testing process is really important to the board members.
It is. In fact, you can tell that from the title of the document. We are very much thinking of it as a pilot approach. We are proposing something markedly different here. In my view, this has the potential to act as a catalyst for significant improvement in the usefulness of the notes. But as with everything we do, it is essential that we conduct our due diligence by exploring with stakeholders whether the approach will achieve the intended benefits in a practical sense. We're not simply taking this approach and rolling it out. Rather, we are doing all of the necessary due diligence first. It is really important to me that we are using IAS 19 and IFRS 13 to test whether and how the proposals will actually work in practice. The feedback we get from this consultation process will be critical to the ultimate success of the project.
It definitely will. Tadeu, anything you'd add to this discussion on application of judgment before we move on to the next topic?
Thanks, Catherine, and hello, everybody. I think that Tom covered it pretty thoroughly. Probably the only thing that I would add is on the point around judgment already being required today. Not only is it required, but we know there are some companies already applying good judgment in preparing their note disclosures. So I'm saying is that it can be done. Looking at the history of this project, I know that before I joined the board a few years ago, the ISB went through an exercise preparing case studies with companies that had done a good job of improving their disclosures over a number of years. So whilst all of the feedback we heard demonstrate that disclosure problem is a real issue today, in my view, it is not the case that companies are unable to apply judgment to their disclosures. This project is really about putting what is needed in place to enable good judgment and high quality disclosures to become the norm.
Thanks very much, Tadeu. So we've already talked a bit about testing whether the approach will really work in practice. And the idea of practical application comes up again in our second discussion topic today, which is all about audit and enforcement. So one thing we hear is that prescriptive disclosure requirements are easy to enforce, or said another way, that auditors and regulators like to tick stuff. So another question we get about the proposed new approach is whether it is enforceable. Could auditors and regulators really be expected to assess compliance with disclosure objectives, given that their application is inherently judgmental? So Tadeu, you are one of the IASB's ex-auditor board members. How do you feel about this?
Well, I feel it's enforceable, but even before discussing this, I think it is important to try and do something that will really address the disclosure problem. Just a couple of years ago, when I was an auditor, and I must confess that I didn't really love to tick things, I completely understand why people ask this question about whether the proposed approach is auditable. Indeed, a requirement to disclose a specific item of information is much easier to tick for the preparer and, of course, easy to audit. But we know that judgment is much harder to audit. But I'm going to start by reiterating what is in the bottom of the slide. Judgment is already required. Companies should already be applying judgment to their disclosures, and auditors should be reviewing those judgments. And today, with the current wording in the standards, based on my own experience, I know that it can be hard to do. So if you are to improve things, we do need to think about a different approach. Much of what Tom talked about earlier is also really important here. So turning to the this slide again. Yes, exactly. I know that it's the same slide that Tom presented. I'm not going to repeat everything he has said, but I would like to highlight a few key things for an audit enforcement perspective. Thinking back to my audit days, if I thought a company should disclose something beyond the items in those prescriptive requirements, honestly, I didn't have much to work with. I mean, in terms of challenging management. That's really because the IS1 materiality requirements, it's at a very high level. And I think that reinforcing those overarching IS1 requirements at the individual standard level and requiring companies to meet that detailed disclosure objectives will put auditors in a better place to challenge judgment than is perhaps the case today. Again, under the proposed approach, I would certainly feel more confident in challenging a company if I thought something additional or different needed to be disclosed. And I'm saying that because I would be able to point to the exact user need that the information would help to satisfy. Applying this approach, a company would be required to disclose information that enables the investor needs described in the disclosure objectives to be met. So I think those conversations between companies and auditors have the potential to be a lot more specific and practical than before. And just one example, in fact, we put lots of things in the proposals that would help auditors challenge judgment. Comparing to the overarching IS1 requirement, these proposals in this exposure draft give auditors loads to work with, detailed objective, explanations of what users will do with information, items of information that could meet objectives, and application guidance and illustrative examples where we believe these are necessary. Overall, I think these proposals have the potential to lead to some real improvement. And don't forget that the project exists because there is a problem today. We have been consistently told about the disclosure problem. I know that some people may see this approach as, let's say, pretty radical. We know that in practical terms, it would lead to a big change in the way we all approach disclosures. But we are doing is testing an approach that could make a real meaningful difference to the disclosure problem. As we said before, this is a pilot project. We did discuss what some might consider a safer approach of developing disclosure objectives whilst keeping prescriptive requirements for items of information, like tweak changes in the disclosures. However, all of the feedbacks we've had suggests that whilst those prescriptive requirements are there, judgment will always take a second place. So what we are doing here is proposing and importantly testing the approach that we think has the potential to really work.
Thanks, Tadeu. And just to reiterate, that testing point is really important. As with all of the board's exposure drafts, stakeholder feedback here is critical. The board has concluded that the proposals in the exposure draft should give companies, auditors, and other stakeholders everything they need to apply the necessary judgments. One reason for that is that the proposals do respond directly to the things that stakeholders told us that they need in order to make improvements to their disclosure. But what we're doing with this consultation is testing that out in a practical sense with those two test standards. It's really important that we hear from stakeholders to find out whether the proposals for IAS 19 and IFRS 13 are good enough to achieve what was intended. And if they're not, what more do stakeholders need? We'll move on then to our third discussion topic. So this is something that the board had discussed a lot during the project, and that is comparability. And the topic has generated a lot of discussion for good reason. When it comes to disclosure, I think there is a long acknowledged tension between entity-specific relevant information and comparable information. A question that is understandably asked here is whether, given the increased emphasis on judgment and relevance brought about by these proposals, would comparability between companies be reduced? We've heard questions around whether the board is concerned that similar companies could apply judgments and disclose different things. So Tadeu, could I please come to you again for your thoughts on this one?
Yes, you can, Catherine. And as you said, we well understand why this question, similar companies with different judgment and disclosures, is asked. It is important, though, to note that, as it is in this slide, uniform information and comparable information are not the same thing. If you have two companies for which the same things are material, then disclosing identical information can be really useful. However, if different things are material to the two companies, then uniform disclosure could be a bit misleading. For example, they could give the impression that disclosures are complete, even if one of the companies has some entity-specific material things going on that should be disclosed. On the other hand, expecting companies to give identical disclosures could encourage the inclusion of immaterial information. What matters, I think, is meaningful comparability, enabling users to compare the material information for one company with the material information for another company. And by giving companies all of those tools to help them disclose the most relevant information, that meaningful comparability could benefit. If for two companies the same information is material and useful to investors, the proposal should lead to both companies disclosing that information, and thus you would get comparability. On the other hand, forcing two different companies to make identical disclosures if different things are relevant to them is not really delivering any meaningful comparability.
Thanks, Tadeu. And at slight risk of sounding like a broken record, we should probably add that those positive comparability outcomes really do depend on judgment being exercised effectively. So once again, the testing of all of this with stakeholders is really important. Have you got anything to add on this topic, Tom?
Not a huge amount. I would very much second what you've both said. It is meaningful comparability that matters, and good application of judgment should lead to that. The value to forcing companies to make identical disclosures becomes questionable if half of those disclosures are boilerplate. And it becomes even more questionable if, as a result of aiming for uniformity, a company ends up missing something relevant in their notes. There are, however, some valid questions about electronic reporting, and I think we're going to cover that now.
We are going to cover that now, yes. So this is our final topic before we go to audience questions. And the discussion point here really is about whether and how these proposals would work in a digital reporting environment. As you inferred, Tom, this is very related to comparability. Now, investors need data that is both relevant and entity-specific, whether that data is being consumed electronically or through more traditional means. It is also true, however, that a more structured approach to financial statements can be helpful to digital reporting because it makes it easy to electronically extract similar data from multiple companies. So again, you can well understand why this question is asked. Now, Tom made reference to the board's IFRS taxonomy team earlier when we talked about common reporting practice. And the IFRS taxonomy becomes relevant again here because it provides a very real way to think through how these proposals would work in an electronic reporting environment. And that's summarised here on this slide. So at a high level, it's the case that every aspect of disclosure requirements developed using the proposed approach could be tagged within the IFRS taxonomy. Now, I'm going to run through each of those aspects. Just a reminder that the different types of objectives and so on brought about by these proposals was all covered in detail during our introductory webinar, and that's available on the website if you would like to listen to it. So the first aspect to talk about is the proposed overall disclosure objective in a standard. These explain investors' overall needs on a particular topic and require companies to meet those needs. The overall disclosure objectives provide stakeholders with context for considering what to disclose and a reminder to check that those overall needs are met by the overall information provided. We'd envisage an IFRS taxonomy element to be assigned to each overall objective, and a company would then be able to use this element to electronically tag all of the disclosures in the financial statements that are relevant to satisfying that objective. That's referred to as block tagging. So that would enable an investor to electronically extract everything relating to a particular topic together. Next, we have the specific disclosure objectives. Applying the proposed approach, there would be a number of these in a standard, and each one of them would explain a very particular investor need and would require a company to satisfy that need. Again, we'd envisage a taxonomy element to be assigned to each specific objective, thereby enabling electronic extraction of everything disclosed to meet that specific objective. Similarly, each item of information named in the standard would have its own taxonomy elements. Now, you'll remember from the introductory webinar that most items of information would be described in the standards in a non-prescriptive way. Disclosure of the items themselves would not be mandatory. Instead, their disclosure would only be required if needed to satisfy the related specific disclosure objective. There would be occasions, however, where the board concludes that a particular objective simply cannot be satisfied without a particular item of information, and in those cases, the item itself would be explicitly required. And there's a couple of examples of those mandatory items of information in each of our two test standards. For the avoidance of doubt, both types of item of information, both the non-mandatory and the mandatory, would have their own taxonomy element associated. One important additional point is that where needed, this would include monetary tags, enabling the extraction of detailed numerical information. Which leaves the final and possibly most important item to discuss being what happens when a company applies judgment and discloses a piece of information that is not explicitly named in a standard. And the answer is exactly the same thing that happens today. The company would need to create their own extension to tag that information electronically. One thing we do hear sometimes is a concern that the proposed approach would lead to loads of entity-specific extensions, thus reducing the ability of investors to extract comparable information electronically. So, Tom, this is probably what you were referring to when you talked about valid concerns on electronic reporting. Do you have any thoughts for those that hold those concerns?
Yes, this is what I was talking about. I can well understand why these questions are asked. The mitigation of potential risks comes down to two things. First, all those important process points that we, the board, have put in place to ensure that everything that's needed is captured in the disclosure requirements that we have proposed. Where a good number of companies are disclosing the same item, you do want them to use the same electronic tag. Things like the common practice review I mentioned earlier make me confident that we will be able to capture things that are often relevant to meeting objectives within the standards. If it is identified in a standard, there will be an IFRS taxonomy tag, as you've just described, Catherine. In short, the first thing that gives me comfort on this issue is that we get our disclosure proposals right in the first place. The second thing is that a company disclosing entity-specific information is a good thing. To be frank, the absence of that kind of information is an important part of the problem we are trying to address. So in the same way that entity-specific extensions already occur today, there will be times when they should occur applying these proposals. If companies are disclosing relevant material, entity-specific information, then that is a good outcome of the proposals. On the other hand, if many companies are disclosing similar information, then I would expect our process to capture this and include it in the standards and in the taxonomy. Overall, the efficacy of the taxonomy and the risk of excessive extensions is a valid concern to raise. Our view in developing the exposure draft was that the process we've come up with would mitigate this risk significantly. That said, I know that many of us on the board are keen to hear the stakeholder feedback on exactly this point.
Thanks very much, Tom, and to both of you. So I have purposefully raised today all of the biggest hot topics on the project. So thank you both for letting me put you on the spot. And I'm probably going to do that again now, because having run through all of the points we had, I'm now going to turn to the questions we've had in from the audience today. So I am going to start with a great question that's come in during the session whilst we've been talking. So I will read it out first. The question is, why do you think that asking companies to use judgment to decide what information to disclose will provide investors with better information than asking companies to apply judgment to decide what in a checklist should not be disclosed? Is the new approach not simply an invitation for less diligent reporters to disclose less? So I could talk for a long time in response to this question. It's a really good one and does get to the absolute heart of the project. I will share a few initial thoughts, and then we'll come to perhaps Tom first and then Tadeu to see what you guys think, because like I said, this really does get to the heart of the problem we're looking at. And I would say that with regard to the suggestion that the board should ask companies to apply judgment to decide what in a checklist should not be disclosed, I would say that IAS 1 does actually already require that. And we know that the disclosure problem exists. So the board did loads of research about the underlying causes of that problem. And paraphrasing hugely, I would say that the existence of this prescriptive list that can be ticked down by companies, by auditors, and the compliance environment and some risk aversion about the possibility of not disclosing those particular items means that despite that overarching need for judgment, that the problem still exists, and what the board is proposing is something that would require judgment and that option of not applying it, even though it's not really there today, but any perception that it's there would be taken away. The other part of the question was, is this new approach not simply an invitation for the less diligent to disclose less? I sincerely hope that if they didn't disclose the information that was material, there would be a compliance failure, because those objectives are required. So I would hope not, is my view. But Tom and Tadeu, I'm really interested in your thoughts. Tom, could I come to you first, maybe?
Okay. Yeah, this is sort of a huge question and goes to the essence of what we're trying to achieve. So I think I'll start with, why is what we're doing so much better than just the list? With the list, there was really no context. The list just existed, and as Tadeu said, it's easy to just tick them off. But without context and an understanding of how users would use them, the entity is not encouraged to sort of put things together in some kind of a narrative, because a lot of this started with simply trying to communicate better. And so if I think about some of the things that we've done here, we have an overall objective, followed by specific objectives. And one of the points Catherine made right at the beginning, we explain why these exist. We explain how the investors and users are going to use the information. So if I'm thinking about providing information to investors, if I start with how are they going to use it, I'm likely to do a much better job. And then we do have these specific items that used to be on just the simple list, but now we've linked them with the specific objectives, so we provide better context. And then we've actually added in some cases to this potential list where we think that there's additional information needed. I think one of the places that it comes up is the information on better understanding the future cash flows is attached to defined benefit pension plans. So all these things together will make a much better package. And I think the great majority of companies will take advantage of this to provide better disclosures. And also the auditors will audit to the objectives and the specific objectives and the user needs. So it should be possible to audit to this more comprehensive goal. Will some companies or managers act opportunistically? There is a lot of research that occasionally managers will do this. And if I think, for example, on alternative performance measures, the evidence is that sometimes people will use them opportunistically. Most of the evidence there is that generally entities use them to try and communicate useful information. And what we're hoping is that with the guidance and enough for the auditors to work with the complete package, that we will really minimize the risk of opportunism, and will maximize the opportunity to produce a complete disclosure narrative on the part of the companies that really want to do that.
Thanks very much, Tom. Tadeu, would you add anything on this question at all?
Again, from my background as an auditor, we already have in IAS 1 this materiality judgment required, and then therefore we are just bringing this to the individual standards and make a better link between the disclosure objectives and why the user needs this information. I mean, that I fully agree with what you said, and Tom as well. I mean, that if, especially in relation to one part of the question, if someone does not prepare this properly, I mean, that is not IFRS. They still can do that. We don't need this exposure draft for preparing a financial statement that does not comply with IFRS. The point is that the way that is now in the standard, it has much more room, especially for the auditors and regulators, to challenge management to see whether the information that is material is really being disclosed. I mean, that this is a much more principle-based approach. That's exactly what the IFRS is.
Thanks very much, Tadeu. Okay, the next question we've got is there an existing schedule or prioritisation of other IFRS standards on which this concept will be piloted? So I'll probably answer that one. It's a bit of almost a project management thing, and I'm afraid my answer is going to be there isn't at the moment, no. But I hope the reason for that no is a very good reason, and it is because of the huge value that the board are placing in the feedback that they will get in response to this consultation, and listening to that feedback and using it to inform next steps is really, really important. So the decision about potential improvements to the approach that's proposed in the ED and about how that approach would be used going forward, both in other IASB projects, but also in applying it to other existing standards, is a decision that the board will only really think about once that feedback has come in. So at the moment, I'm afraid I don't have a detailed answer to that one for you. We had a couple of questions come in advance when people were signing up for the session that I think we have actually addressed during the presentation. So I'm just going to quickly mention them now, so that if those listeners feel they would like more, please submit another live question and we will come back to them. But we had a question about what are the complications of this approach, and on that I would say that we have been very honest in using this webinar to tell you all of the real sort of hot topics and things that people think might be most challenging about this, so the judgment, the effects on comparability, etc. So everything we covered in the webinar I think is the answer to your question, but like I said, do let us know if you'd like a bit more on any of that. And the other one that falls under the same theme, are these new changes going to help users understand companies' finances? And I would say we spent quite a bit of time during the webinar talking about the reasons why the board concluded that this approach of an objectives-based set of disclosure requirements would ultimately lead to better, more relevant information. So I would say in publishing the ED, the board's answer to that was yes. So moving on to some other questions. Okay, we've had a question. You can meet disclosure objectives by just disclosing good news and avoid disclosing bad news. How can the proposals make sure preparers disclose all information and be transparent? So Tadeu, I might put you on the spot again. When you were in audit, would you have been happy if one of your clients had met one of these specific disclosure objectives by disclosing good news and avoiding bad news? Do you think that would be possible?
Definitely it would be possible. My experience, Catherine, is that, and I used to say that, especially when you are in a initial public offer, an IPO, is the moment that probably the investor needs better information. It's incredible how it just become a compliance exercise, and how many times I have already heard about it is better more than less information. And it's incredible how when we face sensitive information, and then in this case, people are reluctant to add this one. When we now turn to these disclose objectives and why the user needs this information, I think that definitely is a better tool for management to understand what is the information is needed to have much more room for preparing better financial statements without this concern, that the litigious situation because they haven't disclosed any information. I mean, that it is much more in a area that they can exercise judgment, prepare a better financial statements, and auditors would challenge management, actually first understand management's judgment, and based on these make the necessary challenges. And I'm sure that in the end of this process, we have a much better financial statement than we have today.
Okay, so I think what you're saying there is that if there was bad news, if I may call it that, referring to how the question was phrased, that was missing, there would be the ability using these proposals to challenge that absence of information and get it in. Okay, so next up, we've had a question about the approach again. So would it be better for the board to instead focus on creating a better, more relevant checklist of disclosure items than you currently have? So I think what's being asked there is, rather than going all the way to judgment, would it be possible to just take the prescriptive list of requirements and make it into a better list, and would that solve the problem? Tom, could I come to you with this one?
Yeah, to some degree, I think we covered that a little bit under the first question, but I'll come back. Is we put in a series of things to help improve the communication, to get investors the information they need. And we thought carefully about the elements that had to go in there. And if you still are just stuck with a checklist, no matter how nicely you phrase it, you haven't produced sufficient context. And in particular, I'll come back again and just repeat, we had the overall disclosure objectives, the specific disclosure objectives to which individual items get attached, which helps create context, help you understand why they're important. And then we're including the explanations of why users need them. And we're doing it in the context of the specific disclosure objectives and then embedding the items in that. So there's a complete framework that's logically coherent, I think, that comes out of what we're doing. And I think it's essentially doing what the person's requesting, but this is how we think you make this list much, much better, by adding all of our elements.
Thanks very much, Tom. Okay, we've just had in a very good question indeed. It is specifically aimed at the board members on the webinar. So again, coming to you both, and I'll start with you, Tadeu. The question is, 3 board members dissented. Does this worry you? So I'll go straight to you with that one, if that's okay.
No, I think it is worth mentioning that despite we have these 3 dissenting or alternative views, all board members agree we have a disclosure problem and we should seek to improve the effectiveness of the disclosure. We already covered in the webinar the main points of concern for those with alternative view, which are basically increased reliance on materiality judgment, comparability, enforcement. And in terms of materiality judgment, honestly, is an inherent part of the preparation of financial statement. It is already in IS1. It's just something that is there. You can't treat this as a mere compliance exercise. In terms of comparability, again, we already covered this one. Uniform and comparable information are not the same, and including immaterial information just to comply with specific requirements, as I said, that sometimes I saw happening in IPOs, will not make the information more comparable. And the last point, it is very much related to my X area. That's in terms of enforcement. Based on my experience as auditor, what we heard from stakeholders, I have no doubt that the current approach is not working well, and a small change in the disclosure requirements, as I said, would not make a difference. It has to be something more principle-based, judgmental, and I believe that auditors and regulators will prefer to work with the proposal and then get rid of full disclosures.
Thank you. Tom, have you got anything to share about the alternative views?
I think Tadeu covered all the key points, and we often have an alternative view, and we have to always be respectful and think about how to address it as everything comes in. The one thing I might add is, at least with respect to comparability, is we do, with respect to the list of items that are linked to each specific disclosure objective, we have the option of making any of those if we really think it's essential to comparability. And we do this a little bit in pensions and a little bit in fair value. We don't want to do it excessively because otherwise we'll defeat the project. But we can always make a specific item mandatory if we believe it's essential to comparability. And when we developed it, we went through and we voted on each mix as we went through as a board. And generally the board members believe strongly that we got the mix right. And again, if people think that we should adjust it slightly, then they can inform us when they review the exposure draft.
Thanks, Tom. Okay, moving on to the next question then. We've had another question about whether this will be rolled out to all of the old standards, is the way the question is phrased. I think we already touched on that in an earlier question, that really is a decision for the future once we've heard feedback. However, the other part of the question says, for this approach to work, doesn't all the thinking you've described need to be applied consistently across the whole of the notes. So if I am understanding that correctly, I think what's being asked is that if we have a change of approach, you've almost got to use that approach everywhere, not just in, for example, IAS 19 and IFRS 13, and be using a different approach to the rest of the notes. That's a really sort of interesting question, and I think there's a lot of fair challenge in there, in the sense that this way of doing things would be a different way of thinking. It would result in a change of behaviour, as we call it, and I think it may well be helpful if that were sort of across the board. However, what I would say is to reiterate some things that we've already said throughout the webinar, which is about the fact that judgment is required today, and I think it would be not ideal for the board to roll this out across everything in the IFRS standards without doing its due diligence. So almost this stepped testing approach is necessary. And to my mind, thinking about the application of judgment and making disclosures more effective is something that can be done using the existing requirements. And to the extent that this approach is providing helpful tools, some of that thinking would, I think, be beneficial, even in a stepped sense. I'm not sure I'm being very clear, but essentially I think the thinking on this project could benefit other parts of financial statement notes, not just the two test cases, because just by going through the act of interrogating how best to apply judgments, that there is potential benefit across the board. Tom, anything to add there, essentially on the question of, does it bother you that this isn't all or nothing?
No, it doesn't bother me, because it's necessary. As I think I said earlier, and when we agreed to do a pilot, we knew that this was sufficiently radical that people would have concerns, and we couldn't possibly roll it out across every standard. And we actually had a board meeting on this. What I'm hopeful, though, is as we roll it out and as people see how effective it is on the two standards that we're doing, that we actually get a lot of pressure to cover the rest of them. And yeah, I think there's a really good chance that once people see how effective it is, that they'll want us to encompass all the standards, which, if it's effective, would be the logical thing to do. But it has to be a pilot first. We have to absolutely prove the concept before we roll it across everything.
Okay, thanks, Tom. And I think we're almost out of time there. So that's, I think, the last question we'll be able to answer. So I will just check. Tadeu, did you have anything to add on that point before I wind up?
No, it's just taking the advantage that, or I don't say that it's an advantage, that we are in a pandemic time, to say that hopefully these two pilot projects will plant a positive virus, as Tom said. I mean, that incentivizing people to extend this judgment, materiality judgment, that is already in IAS 1. It doesn't mean that because we are now testing in IAS 19, in IFRS 13, that you can't use it for the other standards as well. Please be my guest. Feel free to adjust and make your financial statements even better.
Thank you very much, Tadeu. What a great note to finish on. I couldn't agree more. Of course, I'm totally biased, having worked on this project for the last 4 years, but we do believe there is the potential for some real positive change in the effectiveness of disclosure here. And with that in mind, probably the most important thing for me to reiterate as we end the webinar is that the feedback that you will provide to the board is enormously valuable. So if you have any views on everything we've talked about today, or anything else in the exposure draft, please do get in touch with us. The comment period is open until the 21st of October, and we are really looking forward to hearing everyone's views. So all that remains then is for me to thank Tadeu and Tom for answering all of those questions, and thank you to the audience for joining us today and for asking your questions to us. We really hope that the webinar was useful. Thank you very much.